Good morning, everybody, and welcome to our 2022 version of our monthly IFRS and corporate reporting webinars. Hello, Kevin. It's lovely to see you.
Hello, Aletta. Good day, everybody, and welcome to 2022. Aletta, I heard you had some storms down there this morning. Hope everybody survived, and I hope everybody had a good Australia Day. It's lovely to see you all.
Yes, Kevin, as an immigrant, it's taken me 20 years, but I now know that the new year only starts after Australia Day, right? So I'm back at work. I'm ready for the year, and I hope all our attendees too.
And
Um,
Aletta, it took me that long to realize it too, and as a result, I've taken some leave, and I'm actually coming to you today from Orange in New South Wales, where we're spending a couple of days. But I thought I'd dial in to say hello to everybody, and it's lovely up here.
No, fantastic. Now, Kevin, I just want to say in Australia at the moment, there's only one place to be, right? And that is at the Australian Open. So I went last week, and at the moment I'm watching, for the rest of the week at semi-finals and finals. So I'm super excited. Maybe I can delay my work till about Monday. But anyway, we do hope that all of you got some time away, that you've managed to either avoid COVID, or if you got COVID, that it didn't hit you too hard, but that you're safe and that you're ready for 2022. And it is lovely to have you all with us. So this month or today, we thought we'll have a little bit of a look ahead. What's hot and what's not hot in 2022? And Kevin and I have spent quite a bit of time independently doing research on, so what is hot in 2022? And it was really interesting, and we've been talking about it over the last 20 minutes as we were waiting for the webinar to start, that we did our own research, we consulted different sources, we looked far and wide, we've looked at a global level, we looked in Australia, we looked at standard setters, everything. And when we put our slides together, the overlap was absolutely amazing, that we could come up with a coherent set of slides based on very independent research. I think it's a good sign, Kevin. So we're hoping to discuss today, what's hot and what's not. And we've decided to group it into two different buckets. And the one is a board perspective. So if you're a director or a chair or a member of an audit and risk committee, etc., what would boards be looking at? What's their perspective on 2022? And then we've also a second bucket, and that's where Kevin will focus on, is if I'm a CFO or a member of a finance team, what would their perspective be for 2022? And again, you'll see the overlap and the cohesive view of 2022 is quite amazing. So if we start with a board's perspective, now I have to first of all give a shout out to our friends at BDO in America, BDO US, because last year, towards the end of the year, they did a board pulse survey. So they went to a large number of directors, I can't remember how many, board members across a lot of clients and non-clients, and they asked them a number of questions around what they see in the future, what are they looking at for 2022. And the key theme that they came up with was actions speak louder than words, and that boards are increasing transparency and they are pursuing growth in 2022. And I thought that's such an amazing summary, Kevin, of what we've also found in our individual research. So what I've got here is a shout out to BDO in the US, and you'll see at the bottom there's a link to this specific survey. So if you wanted to read the whole document, they've got amazing information in there. Please go and look at it. And they've given you an idea of, who they've contacted, market capitalization in the US, the directors, some of them that they've surveyed, 36% of those directors have over 10 years of tenure. 26% 6 to 10 years, etc. So they've got a broad range of experience across the directors they've surveyed. and they've also looked at these board members. They are often on more than one board, and given you some stats on that. But you can download the report for free, and I think it's amazing that the themes we've seen there are similar themes in Australia, and we all know the world has become very small, through Teams, through Zoom, etc. In the old days, we would have said through airplane. The world's become small, but these days through Teams and Zoom, the world's become small, and we're seeing very similar themes. Now, if we look at the key findings from that report, they said, first of all, the number one priority of boards has been engagement of shareholders and investors. Absolute number one priority. Then they also have a finding, the second one, M&A is the top-ranked corporate strategy, mergers and acquisitions. The third one is around cybersecurity and data privacy. Then the fourth one around supply chain disruption. The fifth one around labour shortages, which we can all relate to. The sixth one is ESG issues. And the final one, annual reporting and continued pressure on disclosures, especially around risks facing the organisation. Now, I'll talk about each of these in a little bit more detail, but again, if you want to read more, you can look at that report. Now, the very first thing, as I said earlier, they said shareholder and investor engagement is an absolute top priority for the boards. Now, this is something that we've seen in our client base and we've seen in Australia. We've received phone calls from so many board members, finance teams, saying, listen, our shareholders are asking these questions. We received these questions at an AGM. Investors are asking the following questions. Or before the AGM, these are the questions we're expecting. How do we respond to these? So I think these days we've got a more active shareholder and investor group that are approaching organizations and asking questions. Now, I know a lot of those questions are currently driven around sustainability and ESG as a key thing. As an example, but we'll talk about that a bit later. But I think that relationship that boards have with shareholders and investors really critical. And what's interesting out of the report, they've said, it's in times of uncertainty, strong corporate governance is paramount. And boards understand that the increased pressures they are under from all stakeholders to successfully guide their organization into the future. So there is uncertainty. Stakeholders and investors realize there's all of these pressures and uncertainty, and they're looking to the boards to guide them into the future. So absolutely a lot of pressure on our board members and boards, and therefore, an absolute top priority to continue to engage constructively with stakeholders and investors.
Aletta, could I make a
Yes.
comment? And I'm sorry if I'm jumping in, but it's really interesting listening to you. A lot of what I gathered for today's presentation in the CFO and finance team section was based on my own personal observations as well in the IFRS and corporate reporting team in Sydney. And one of the things I've noticed is the number of board members who are joining CFOs on calls with me. And this leads to what you're talking about here. I mean, and it actually happened really quickly. I'd say in the last 4 months leading up to the end of 2021, I mean, I could count on one hand the number of times an audit committee member or a board member was actually on a call with the CFO when we were talking with, some of the advisory work we were given. And very, very rapidly towards the end of last year, suddenly board members or like a representative board member would attend a call with the CFO. And they weren't against each other. They were coming as a united front where the boards was actively participating in the finance functions and reaching out to try and deal with some of these issues we never been consulted on. So that's really an observation that sort of runs alongside what you've just said about, stakeholder engagement, boards being actively involved. Just an observation.
Yeah, no, Kevin, I do agree with you. And I think the number of times that we in our IFRS and corporate reporting team have been asked to present to full boards on sustainability, on corporate reporting, on latest developments, which was unheard of a number of years ago, a number of months of. And
That's right.
also, as you say, interactions with Audit and Risk Committee. And often, the chair of the Audit and Risk Committee will reach out with the CFO to talk about matters. And I absolutely agree with you. So I think it's really important, although we've put our presentation also in two buckets around board's perspective and CFO perspective, the overlap is amazing. And I think it's also important if you're a CFO or a member of a finance team that you appreciate the pressures the boards are under and what they are looking at and vice versa, right? So the second thing that came out of this survey was the eye on growth strategies. So M&A is the top ranked corporate strategy, and there are plans to explore acquisitions and new revenue streams. So also plans to explore that have increased. Now, Kevin, I know we've seen that as well. If we look towards the end of last year, I know, November, December is IPO season, but the IPOs and the number of IPOs have gone off the charts at the end of last year. I think there's a lot of opportunities to acquire maybe struggling businesses, to grow that way, to improve supply chain that way, to look for additional revenue streams by diversification, to not be too reliant on one particular revenue stream. And then I think the other thing we've also seen is that the amazing way businesses have pivoted during COVID. We might have been a manufacturing organization, manufacturing X item, and during COVID, we become manufacturers of hand sanitizers or rapid antigen tests or whatever. So I think that's something that we've also seen here. This I found really interesting. They do this pulse survey very regularly, and therefore they had the data to contrast and compare the board's corporate strategies over a period of time. So they've looked at in September 2020, they've looked at February 2021, and then September 2021. And if you look at the items here, the first one, seeking or expanding an acquisition strategy, over that period of time, which is basically 3 points in time over 24 months, we've gone from 21% to 50%, of these organizations looking at seeking or expanding acquisition, more than double. The middle one is introducing new or alternating current revenue streams, from not really applicable to 43%. Amazing. And then the last one, seeking additional capital infusions, 22%, 30% down, back down to 20%. I suppose during COVID in 2020, maybe or early 2021, a lot of uncertainty. There was a spike, but now back to pre-COVID levels. So I found this really interesting on how the strategies have evolved, and absolutely a focus on acquisition strategy. Now, the third one to look at is cyber and data privacy priorities. So this is a significant governance issue for all companies. I know at BDO we have a whole team of partners and staff who focus on cybersecurity, and this is a real key thing for organizations and for customers of organizations to make sure that their data are secure and followed with the new regulations. So this is a big issue. I know during COVID, I read an article, one of the BDO articles, that said during COVID there was such an increase in scamming activity to try to get people to provide bank account details, etc. You won't believe it. Recently, we actually received a week ago an email from the school that my youngest children go to, where they say, please be careful. Don't pay your school fees to a new bank account number. The school's bank account number hasn't changed, because they've become aware of parents receiving emails saying you have to pay your school fees and this is the new bank account number, etc. Amazing. I don't know about you, the number of calls I've been receiving around, you haven't paid your tax and they're going to put you in jail, and even with all the online deliveries that arrive at my home with all my daughters, and now you get these messages to say you have to click here and put certain data in, information in, because there's been a delay on your delivery. I mean, unreal. All the issues we're seeing around cyber, data privacy, and scamming and fraud activities. So this is a significant issue for organizations. In the BDO 2021 Middle Market Digital Transformation Survey, they found that 90% of middle market organizations are maintaining or increasing their digital spend in 2021. So this was done at the end of 2021, September 2021. Now, Kevin, this is absolutely what we've seen in our client base. In 2020 and 2021, suddenly people are working from home. We need increased technology. Everything's going to the cloud. And even from an IFRS perspective, that we had all these discussions around how do we account for these costs that you've incurred. Because no longer is it necessarily software that you control. It's an on-prem solution. It's actually a cloud solution. So how do we account for it? And we know there's been an IFRIC decision around that. And a lot of our clients had to do a lot of work on how the cost you've spent on customizing, and connecting and configuring with these new cloud software solutions. And that is continuing. This is continuing because with the new Omicron virus, and we don't know how many different versions we'll see in future, people are working from home, working remotely, and we need to make sure that our technology can deal with that. The next one is around supply chain management. Now, the risk of supply chain disruption is something that boards have to tackle, and they are looking at sourcing diversification. It's quite amazing if you look at the impact that supply chain has had on Australian entities. We're currently doing some renovations at home, an outdoor kitchen, etc. And constantly we run into, we can't get this stock, we can't get stock, we'll wait 6 weeks, delays. Now, this is just me as an individual. It's no big deal, we can wait. But if you look at organizations to make sure that they get their goods, they've got it available, is really important. So organizations have to address supply chain management, and it's something that boards are looking at. Again, very interesting issues that boards see the supply chain as a top area of concern, and many are taking steps to address it. Now, first of all, 32% of board members anticipate supply chain production disruption will be their greatest business risk for the next 12 months. 31% say supply chain challenges will be the biggest impediment to their organization's economic and operational success for the rest of 2021. And 23% are considering expanding the diversification of their business supply chain. And if they look at, a strong supply chain management, the things that they're looking at doing in that little delivery truck, diversify sourcing, maintain liquidity, digitize the supply chain, and improve demand forecasting. I've got a really good family friend who work in supply chain, and they are extremely busy digitizing and improving supply chain. Human capital management. Now, we all know about labor shortages and scrutiny also around board composition. And so it's really important that we have to be very careful and thoughtful when we look for new staff, new board members, and that our processes are robust. Now, in Australia, I would say we have an additional impediment, and that is the strict migration and visa requirements that we have in Australia to get top talent to Australia. So to mitigate these labour challenges, what are businesses doing to attract and retain talent? They are looking, at the following strategies. 55% are completely reimagining flexibility and remote work. 51% are emphasizing diversity, equity, inclusion, something very close to my heart. 46% upskilling workforce. The request that we're currently getting for training is absolutely amazing. We want to make sure that our workforce are more effective and efficient, and by upskilling them, we can achieve that. And we want to hang on to existing staff. So let's invest in existing staff. Enhancing employee benefits, 37%. That's not the number one thing. Paying people more is not necessarily the way to go. It's nice, but not the only way. Other things too. And then the last one is focusing on corporate social responsibility and philanthropy. Extremely important. And we're seeing it at BDO, and I know through my work in ESG and sustainability, organizations are seeing it. Staff want to work for organizations that have a real purpose and make a positive impact. That brings us to ESG. ESG for the near and the long terms. ESG issues remain high on boards' priority lists. They want to explore options on how to best comply with changing requirements. And as you know, there's a new International Sustainability Standards Board established at COP26. And I think a very important thing, and we're working with many organizations and boards at the moment. The issue is, how do we stay up to date with these changing requirements? And how do we communicate our efforts around ESG and sustainability to the public, to investors, to stakeholders? Because many Australian organizations are doing quite amazing stuff. But what's the best way to communicate that? Which framework to use, etc. Now, this is another amazing infographic they've put together. And I might just say, I do apologize for the coughing. I've had COVID, but I'm well, but I've got this lingering cough. I had COVID in the first week of January, but this cough is just not going anywhere. I'm feeling well, so please don't worry. I do apologize for the cough. If you looking at boards, there's three aspects. In the near term, is it a priority for 12 to 18 months? Is it a priority 18 months to 3 years? Or, there's no plans to implement in the next 3 years is the maroon. And if you look there, creating an ESG specific board committee, some people are already going there. We've got clients doing that. Many organizations in Australia are actually putting the ESG as part of audit and risk, and the audit and risk committee is managing it. Keeping up with evolving regulatory guidance to ensure compliance with reporting, 73%. That's amazing. I mean, IFRS is still, preparing audited financial statements. Building a more diverse board and leadership team, 55%. We'll see that within the next 12 to 18 months. Aligning ESG reporting metrics with corporate strategy, 38%, 12 to 18 months. Improving positive environmental impact, fairly high, 12 to 3 years. 33% no plans yet. Focusing on social issues, that's important to stakeholders. Interesting, higher. The social issues rate higher than the environmental impact, if you look at those two. And then creating an internal ESG reporting framework in the next 12 to 18 months, 44%. And that's absolutely what we're seeing. We're speaking and working on so many clients where we're getting that internal reporting ready. And then finally, keeping up with disclosures. In America, they said for 31 December 2021 approaching, boards anticipate challenges around increased disclosures and risk, but we would say 30 June 2022 coming, a similar thing. And again, they've done a survey. They said if you look at ESG, 43%, the highest is a focus on what are we going to do around ESG. Disclosures, 33% around emerging risk to the business, which could include ESG. 28% increasing time and effort devoted to accounting estimates and forecasts, 14% additional income tax effects, 10% enhancing disclosure on liquidity factors, 10% auditors disclosing critical audit matters in their audit report these days, and then also 3% reporting on the use of government relief fund. So these are the focus areas of boards heading into 2022 around disclosures in particular. So that was an overview of the key themes of what we've seen, what boards are telling us, what their perspective is on 2022. Now, watch out. I'm going to hand over to Kevin, and Kevin is going to talk about a CFO and a finance team perspective. Look for the overlap, look for the synergy. Quite amazing. Kevin, I'll hand over to you.
Thank you, Aletta. Thank you for that, and hopefully you can give your cough a little bit of a break. But that was a great overview, and I'm actually amazed. I know that Aletta sounds like kids in a candy store about how amazed we are that there's an overlap, but I'll repeat that again. So a little bit of background for this is because I was taking a couple of days off, I actually got onto my slides a little bit earlier than Aletta did, and so I actually did this part first. And the way I went about it wasn't to look at the pulse survey. Aletta was looking at that, but also looking at sort of the board information that she has. But I came at it first and foremost from a lived experience. The last 4 months leading up to December last year, it was a noticeable change in the type of assistance we were being asked to provide from CFO and finance teams in the IFRS and corporate reporting team in Sydney. So the four things that are on the next slide, Alessa, were actually my, shall we call them, personal experiences put down into four sort of buckets. Now, there's some other things built in here that weren't all my experience. I did reach out to other people as well and talk to sort of some friendlies in the CFO space. And I must admit, I went to the cricket with a whole bunch of CFOs over the holidays, and so it was nice to sit there and talk rubbish about what's going on in the industry. So some of this was confirmed actually dealing with some CFOs on a sort of a personal basis. So the break was kind of a lived experience for me that these four buckets developed. And they absolutely overlay with Aletta's, completely on every level, maybe just a little bit more concentrated. And that is because these are the lived experiences. These are the things that the CFO and finance teams are running into and need help immediately with. Now, the reason why they need help with it is, yes, we've had problems recruiting people. So there's no doubt about it that the finance teams are suffering from a lack of skills. But I think it would have happened that we were sought out by our clients anyhow, because even if we found staff, these issues rapidly became relevant to a large number of finance teams, and the skills wouldn't have been there anyhow. Because it just wasn't the sort of things we were looking at before. So I'll start from the left-hand side and say pandemic stimulus. I mean, Aletta actually was running with pandemic stimulus and the National IFRS and corporate reporting team. They were dealing a lot of articles on pandemic stimulus during the pandemic. How do we account for this? How do we disclose it? Notice those words that Aletta was talking about: disclosure, disclosure, disclosure. But what actually happened towards the end of the year is it became really relevant to a number of my clients in Sydney that they no longer had the stimulus, and now they had to try and communicate where the money was coming from going forward. Now, that's a really interesting take on how do we communicate financial risk, financial disclosure, that the stimulus is gone, going concern risk, all those other sorts of things. And a lot of these clients never really disclosed sort of financial instrument risk, financial risk disclosures before, or what they did before, they used to have very boilerplate type disclosures. And what actually happened, they actually had to start doing something that was really specific to them. They had to start talking about it actually in language that not only was relevant to their organization, but also to their investors. And I'm not even talking about listed clients here. I'm actually talking about large proprietary limited proprietary companies who were talking to their creditors, to their employees, and the pandemic stimulus really became something that was really interesting. That was the first thing. And notice how I used the word honest communication there. boilerplate disclosure has always been an ASIC focus area and also an IFRS focus area, how to move away from this sort of cut and paste mentality out of model financial accounts and actually use your financial statements and your reports to your investors as a communication tool. And notice the word communication. Aletta used that a lot in her section as well. Using your financial reports as an absolute communication tool. Some CFOs call that a marketing tool. Use whatever language you want to on it. It's becoming a really important tool of business. And how to kind of get that message across. But it feeds into the next one, which is deal and lifecycle support. Now, I've come up with deal and lifecycle support because a lot of what I do in the IFRS and corporate reporting team in Sydney, we deal with a lot of IPO readiness work. Aletta used the word M&A, and that's fine, mergers and acquisitions. Absolutely, it's the same column really. But the reason why I'm calling it deal and lifecycle support is it's not all M&A in the work we're getting. I'm actually getting a lot of work in the early stage life cycle of companies. Some of the companies that got themselves created just before the pandemic have had the hardest time being relevant and keeping themselves actually solvent during these periods. You know, they didn't have the luxury of muddling through a new idea and building new software or research and development. They actually had to kind of navigate a pandemic during that early life cycle support. And those are the ones that have gone looking for money or finances from interesting places. So it's not only M&A, but it's also, you know, looking for finance, early stage finance, and seeking out venture capitalists and anybody who can really give some money to you. And that all falls under that category. One of the big things with that is risk. And this is maybe a cautionary tale to CFOs or really anybody at the board level who is looking for early stage finance. Be careful of the investor that wants it all. Generally, what seems to happen in these companies is that they'll take anyone who will give them money, but it normally comes with a caveat, and that is that when the upside comes, the dealer, the investor takes it all. And we're getting a lot of requests to make sure that those risks and those areas that you can't really see at the start of the arrangement sort of creep up later on in the life cycle. They come back to bite a number of companies. So, you know, that's an area we're getting a lot of requests for support on, and I've got some slides later on we'll talk to. The new and developing reporting standards. One of the interesting things that's hot in 2022 for me isn't so much compliance of financial reporting standards anymore. Nobody comes to us to ensure compliance. They come to us to integrate their financial reporting throughout their business. Now that's a sort of an integrated reporting type approach, but it's the same with sustainability measures. Sustainability measures do not exist in isolation. They are measures that integrate with corporate strategy, but which you also need systems, processes, materiality assessments in order to work out these data reporting factors or indicators, which then feed into financial reports. And the worst thing you can have in sustainability measures is a measure that contradicts your financial reporting, and that's what we're starting to see is this integrated approach on the reporting standards. But one of the areas that really reared its head in the end of 2022 was a number of my clients who are trying to integrate IFRS into their budget and month-end cycle. It's really now happening on a large scale, and sort of getting scale through the industry. And we're not just talking large PTYs and listed. Going back to those early life cycle finance support seekers, is even if you're a small company which you've got a great idea and you're in the R&D phase, a lot of the venture capitalists and, shall we call it, the US or North American financiers, they want IFRS type financial reporting, and they want to see that integrated into early stage systems. And so we're getting a lot of help or requests for assistance in that space. And then that leads to the finance function effectiveness, which is essentially to improve operational practices. The days of Excel reporting are way behind us. And I think if you're doing complicated transaction reporting using Excel as a CFO, I would really say to yourself, is this the most effective way to do things? The answer is probably not. Now, Aletta and I have been banging the pots for years on BDO lead and lease accounting, but that's just one subject matter area where we see this problem. You know, moving beyond Excel, because it really just doesn't keep keep up with what's needed on a month-to-month or operational basis. You know, when a financier wants to see financial reports, he doesn't wait for audited accounts in a year's time. He wants results published at the end of the week or in the end of the month to see what the last quarter looks like. And you've got to be up to scratch with your operational practices in order to collect data, process that, digitize it, into some sort of reporting structure. And then following on from that at the board level is cybersecurity and all the things that come with it, which is what Aletta was talking about earlier. So it actually fits together really, really nicely. Now, the reason why
Kevin,
I'm yes, Aletta.
I was just thinking, that finance function effectiveness. You and I and across Australia, we've had a lot of clients who phone us in a panic and say, there's a transaction happening, or it's year end, or the auditors, whatever, and our finance team's struggling, and they look at, and because we've got all these staff shortages, they're looking for people. They want people to come and help them on a secondment or for a period of time. And I always say, we'll find somebody, and sorry, we will help you. It wouldn't necessarily mean a person, but
That's right.
what is the immediate problem? And let's solve that. But
Yeah.
then I think it's really important when our team go in is to say, let's get over the immediate problem, but let's look at how can we make this function more efficient and effective, because that's the future. You don't want to come to BDO or any firm on a regular basis. You want us to help you now, but also look at how do we do it better going forward. And I think
That's
that's
right.
critical. It's that value add that organizations should be looking at. Um,
Absolutely. And it's funny you should say that, because I think most of last year I lived from one week to the next in terms of my client, my value proposition, because most of the clients were emergency calls and I need this by the end of the week. But what they failed to do, which we've had to try and encourage them to do, is, okay, you got past that hump. How can we not make this happen next time? And also those of you in the life cycle area, those who are doing IPOs and going through that cycle, don't, once you've hit the IPO and you successfully listed, or you found the finance function from it, don't drop off the operational effectiveness, because it's never going to get easier. It's always going to get harder. And so it's always the most successful companies and the most successful CFOs and the most successful finance teams are the ones that when there is a little bit of downtime, they're actually planning for the next disaster or the next catastrophe. And if you're not planning for that during the next catastrophe, then it's just going to be another catastrophe when it hits. So absolutely, Aletta, and that's what's hot in 2022 is plan for the future, put the necessary things in front. And notice, Aletta and I, we've gone on a long journey ourselves. When Aletta and I started this, IFRS was an internal thing, and we're doing internal consultations to clients. I mean, boy, have we come a long way in what we offer to clients. We've moved very much out of the IFRS technical, this is what the compliance looks like, to these sorts of hot topics, which are finance function effectiveness, integrating standards in, support during big transactions, and then follow on effectiveness after that, because that is what the way of the future is. What's hot in 2020 is laying the groundwork for the upside down the track. So yeah, look, that's a nice little checklist. I like the board one that Aletta did, but if the sorts of questions I've been getting in the last few months is anything to go by, those 4 areas are really key. And I just want to make last point on pandemic stimulus. I don't mean disclosing pandemic stimulus. I think we're past the disclosing pandemic stimulus, but it's a matter of moving past the stimulus now and actually finding, shall we call it, something that is a sustainable finance approach to managing money and how that gets disclosed. So funding and transaction support, I'm going to deal with this one because um, I, I think we've always talked about convertible notes in the past. I think we actually did a couple of sessions on this last year, Aletta, and those of you who follow us every month, you'll know that convertible notes was the biggest thing. It's kind of a convertible note session, but we've moved way beyond convertible notes now. We've moved to exotic financing type structures which embody convertible notes, but that is what I'm seeing a lot of again. It's virtually, I would say we're up to 2 major transactions a week now that we get in terms of queries, not only from clients, but also internally from other service lines. And where they're popping up is actually during the life cycle. It's not just those guys who are looking for IPOs and sort of going into a listing. It's actually very much appearing in the second block from the left, which is the growth and funding stage. So early startup companies that are just at the end of their research phase or just entering their development phase, and they're running out of cash, and so they go looking for funds. So it's not just IPOs and sort of extracting cash phase, it's growth and funding phase. So that's the second block, a little bit of expanding. And then when you do get to the extracting cash and IPO, which is on the other side, we actually get a lot of these queries as well. But what we started to see on the next slide, I think, Aletta, I think I've put together, the cash-rich investor. Caution, caution, caution. Now, this is not a caution about taking money from these guys. It's a caution about the sorts of instruments that you get yourself wrapped up in. Now, I'm talking to the CFO and the finance team here. I'm not talking to the board per se. So the board will make decisions at this point to go and seek particular funding from certain investors, and that's fine. That's what the board's supposed to do. Off you go. But the CFO and the finance team will have to account for these things, not just accounting, but also disclosing, drawing up finance and risk policies, hedging policies, all these sort of ripple effect type policies and processes that need to be integrated through the organization. And it'll come from the cash-rich investor. And what I mean by that is you'll often get a sort of instrument that's really complicated. I always used to have my 3 plus 30 plus model. Aletta, I don't know if you remember that, but I always used to say that if you get a finance or a loan deal that's got more than 3 pages of definitions and is more than 30 pages long in terms of its contract, that means you've got a complex transaction in front of you. And what that normally embodies from a CFO and a finance team is that you actually need to have trusted advisors, such as us at the IFRS and corporate reporting team, to assist with some of the accounting complexities, but that ripples beyond that. It ripples to making sure you have access to specialists who can help you value these things, because most of these have to be accounted for on a fair value type model. So you're not just doing debits and credits here. What you're doing is actually regularly measuring these things using complex models and complex valuation techniques, and then that drives to building processes and procedures that not only account for it, but how can you actually better report the effects of those? And that's where you get some of the more sophisticated finance teams will start to build hedging policies that are designed to protect against volatility in their profit and loss. So hedging policies that actually can help the organization report a better result for these types of instruments. And I just want to make the point again, this is not listed and early listed. These are any organization, especially those in the early stage. In the early stage startup, you don't have money for great investment in systems and processes. So what you find yourself doing is running around like a headless chicken 3 days before reporting, trying to find a valuation expert to value a complex embedded derivative. And that's really something you really should try and guard against in the CFO and finance team this year, is just get in early. Now, this is a practical little slide. I had a quick think about this on Monday night, and I thought I'd put together a couple of funding arrangements we've seen. Now, one of the biggest mistakes that CFO and finance teams do when it comes to these complex arrangements is they like to convince themselves that the thing that's in the contract that will never happen is never going to happen. So you'll enter into a contract with a financier or venture capitalist, and I'll start with one in the middle, the one with caps and floors. It'll be something like a convertible note that'll say something along the lines of, if the share price drops below a certain value, then a certain number of shares will actually have to be issued on conversion. And the CFO will say to me, that'll never happen. Well, that's just there to protect the investor. I'm like, yeah, it's not only there to protect the investor, it's actually there to give all the upside to the investor, and they are actually banking on that happening, and you're banking on that never happening. So you get this disconnect between the CFO and the finance teams, where the finance team or the company doesn't want it to happen, obviously, but the investor does. And most capitalists and most financing coming from the US and from North America, they design instruments like this. They want it to go against you so that they can get all the upside. And those upsides ultimately not only have to be accounted for, but disclosed in risk policies. You need to be valued and so forth. And very often at the start of the arrangement, it may not have a lot of value. But as the arrangement ticks over, and as the company builds, and as the share price starts to change, and as liquidity becomes a problem, the upside for the investor starts to have value. And those values very quickly become reportable on balance sheets, need to be valued, need to be integrated into risk policies. And this is when the true effectiveness of finance teams is put to the test, is when these need to be accounted for. So I've put these as an example of the sorts of arrangements that embody everything we've spoken about today: stimulus, funding, disclosure of risk, effectiveness in the team, access to specialists and trusted advisors, and also sustainability measures. Because sustainability, as Aletta says, isn't all about government, isn't all about environmental, it's about governance as well. And let's face it, if you can't govern through your finance team on some of these, you can't meet the G in ESG. So it's all connected. Look, I'll run through very quickly some of the other ones on there. Most organizations that are going through these are no longer that exotic to me. These are daily questions we get from a lot of organizations where they're entering into these things with early payment, repayment options, lots of settlement choices when it comes to IPOs or capital raises. So this is where you're entering into arrangement that when a capital event happens or a liquidity event happens, which often means another capital raise, the investor gets to choose how to be settled. Conversions into shares of another company. This is one in the bottom right hand corner, suddenly seen a lot of organizations entering into financing arrangements which very quickly result in the conversion to shares in another company, normally another group entity or another entity in another country or a parent entity, something that's really sort of starting to appear. Warrants, where you give away options for more shares, and what that basically means is when certain things happen, the investor can buy more shares at a certain price. They're all becoming really throughout the industry now. I'm seeing it more and more in virtually all sorts of entities of all sizes in all stages of the life cycle process. So if you want to actually start with anything that looks at the hot topics we've spoken about, effectiveness, specialist, accounting, disclosure of risks, take one of these funding arrangements if you come across it and build your systems and processes around it. It's a good one, which is embodied in a single contract that can help you take up the challenge of some of these hot topics we've been talking about and actually start to build around it. I put here just for fun our little debt and equity decision tree, which is actually something we use as a tool at BDO in terms of how to determine the appropriate accounting of certain convertible notes. But really anything that has sort of components that are debt and equity related, you can use this. And I put this up not to run through it, but to just show you the complexity of approach in determining the appropriate accounting. And notice that anything that says derivative liability requires a valuation, which needs to be valued every reporting date, which probably means you need to build a valuation model with a valuation expert. So those things cost money, they take time, get in early. It is available in BDO's publication, which is available in our publication section online. It's an IFRS in practice publication, which talks about accounting for convertible notes, and it's something of a it's funny how I actually see these a lot in client assessments that it's something of a must-have in the industry. Even outside of BDO, I notice people use this now, so it's becoming a bit of an industry publication that everybody must use. This is just an approach to risk. I mean, if you're starting this out in terms of a funding arrangement, so as I said, you take a funding arrangement and you start to actually look at this. Don't just run around trying to get accounting advice and kind of get the accounting. Look at it from a business risk point of view. What is this thing telling me? Now, if you take it on an instrument basis, these things are often going to give you liabilities on your balance sheet. That's not great for anybody who's looking to raise funds or IPO. More liabilities, debt to equity ratios, those sorts of things don't help companies in these arrangements. So very often you start with an instrument that gives you a liability when during the negotiation phase you think it's all equity. They need fair value measures for derivatives at all reporting dates. You need expert valuers, and your earnings volatility at the bottom are really the things that most CFO and finance teams want to avoid, because let's face it, boards and stakeholders don't like that. So if you want to be a CFO and you're trying to manage those sorts of risks, it's actually the one at the bottom that you're going to come under most pressure to value. It's not just the processes and the procedures, it's the earnings volatility that you're going to report up to the audit committees and to the boards. They're not going to like that. And the way you can do that is, sure, you have this arrangement you've got to account for, but maybe that's where you need to implement things like hedging processes and hedging policies to try and avoid or to minimize the effects of earnings volatility. This is a great example of how you can start to manage all those hot topics we were talking about earlier on. I think, Aletta, I'll probably, yes.
I'm just doing a time check. As you know, our New Year's resolution is to keep these webinars in an hour.
Yep,
We've got 10 minutes to go.
that's right.
So I thought if you look maybe at the special purpose 5 and I'll look at lease accounting 5, something like that. Is that okay?
I think I'll even challenge you and say that my special purpose will probably be 2 minutes, and then you can maybe have 8, Aletta. So let's do that.
Okay.
So what's not hot in 2022? Look, there's 2 areas that are not hot. Lease accounting in Excel, that's my bugbear. I won't spend a lot of time on that. Let's take that one. But honestly, the number of queries I get with when it comes to lease accounting where they're using Excel to do these calculations, not only is it becoming administratively burdensome, but they're getting the numbers wrong. And when we normally convert them into a video lease management or a software as a service approach, we actually have to try and calibrate the error from last year's in Excel to this year's in video. Aletta, you can take that one. On the special purpose financial statements, I mean, it's just no longer a hot topic. In fact, if you're still on special purpose and you're lodging accounts, on every level, it's time to move across to general purpose financial reporting. Now, on some entities, and those are your for-profits, that's mandatory in 2022. But to be honest with you, if you're a CFO worth anything, worth your weight in gold, it's time for you to actually rationally look at this and say, well, actually, even if it's not a compliance requirement, it's time to build my processes and procedures and my policies that are driven on a general purpose basis, which is start to embed generally accepted accounting standards, which is IFRS, into your processes and procedures in line with IFRS and AASB, and this is the year to do it. If you are lodging for-profit accounts this year, 2022, and you haven't yet converted to general purpose financials, it's a mandatory year if you haven't already done it. I almost want to say I think it's actually already passed, but I think 30 June 2022 is the drop dead date, and so you're there. This slide is, you've reached the right-hand side of the slide. There's nowhere else to go. It's time to do it now. And we do have a 5 or 6 step model that you can use to get there. Now, this is a transition model that's created from IFRS 1, but it actually is a great roadmap in terms of how to select policy processes, reclassify items, applying AASB, and then on top of this, we've actually got a nice model we can help you with where it comes to actually building processes and procedures around it. This roadmap here, it actually comes from a Canadian approach that is used, which has been maybe just amended a little bit. I did this one weekend last year during lockdown when I had no life and I was sad and lonely, and so I kind of put this together, which is really just a project roadmap that you might want to use in terms of diagnosing your needs, designing and planning a process, solutions development, implementing post-implementation review. And look, video, the IFRS and corporate reporting team, including I guess the sustainability team that's developing in that, would use similar type project management approaches depending on the topic to actually help you through those processes. So please feel free to reach out if you need. Okay, it was 3 minutes, Aletta, not quite 2. With that, I'll say thank you for listening to me, and I'll hand over back to Aletta.
Kevin, I cannot imagine you being sad and lonely, even in COVID. But anyway, thank you very much for looking at those. You can see that Kevin and I are taking the feedback very seriously. And one of the feedback was we have to keep this in an hour because people have lives and other things to talk about. So thank you, Kevin. So on lease accounting, Kevin said, one of the things that are definitely not hot is doing lease accounting in Excel, or I would go further to say doing lease accounting in any system that's not being a smooth, giving you what you need, a one-stop shop. There shouldn't be workarounds outside the system. Everything should be in the system, and it should easily give you the money or the journals, etc., to go in your general ledger. There's just no time to fluff around with lease accounting, with Excel calcs or systems not working. I thought by now, 2022, lease accounting would be long forgotten. As you know, we've got 2 offerings where we sell BDO lead software as a service, and there's a video on the website that you can watch about it, on the benefits of it. And there's also the outsourced model that we've developed in Australia, where we currently manage outsource or lease accounting similar to payroll outsourcing for many, many clients. The pain actually is very real. It is still very real in 2022. This morning, I started my day with yet another call, panic stations, and we have to redo whatever they've previously done for FY20, FY21, as well as the half year up to 31 December 2021. Absolutely amazing. If your starting point was not right, if you've not appropriately accounted for COVID concessions, reassessments, modifications, and not have a seamless process to update your data, it is pain on steroids, absolutely. So we have a dedicated team that sit across Australia that work on helping clients redo everything, get it in a seamless system, reconcile back to what they've had in audited accounts. If there are differences, explaining differences. So I think it's a huge task, but this has to be streamlined. Definitely, organizations cannot continue to grapple with lease accounting. Absolutely, the pain is real. We are still seeing that, how do we have a process, not just a system? The system is just a technology solution. You need a process around it to get the flow of information from the property team or whoever's negotiating new leases, whoever's making the lease payments into your system, and that the output is seamless into your financial statements or your management accounts. So how do you identify new leases that's been terminated, identify reassessments, CPI adjustments, market reviews, identify modifications, identify COVID-19 rent concessions, and really seamlessly dealing with those. Something that's still a problem. I'm continuing to spend a lot of time explaining, how do we determine an appropriate lease term? There's a lot of judgment involved, but you have to be able to defend it. And how do we do that? What do we think about? A holdover lease or a lease that is on a month-to-month basis is not a short-term lease. So, we're not necessarily immediately a short-term lease. We need to assess. And still, this diagram, absolute gold on, when do we need to update discount rates? Do you have a model to update discount rates if you regularly have new leases and modifications? Do you know when to update it? Do you know when you expect a P&L impact? So these things are critically important. Do you know that the practical expedient for COVID-19 concessions have been amended last year? So it's about knowledge. It's about your people having the knowledge, or working with people who have the knowledge. And what I've seen is a lot of the lease accounting tools are driven by IT companies. And when you call the help desk, you speak to an IT person. I think we have to understand and realize you need a tool and a help desk that's actually managed by people who understand process improvement, who understand IFRS 16. That's what you need, so that you can really solve the business problem. I want to end up with, do you need assistance? Now, it's amazing, and I want to thank you all for joining us for our webinars. There's a link to the webinars scheduled for this year. We will also be scheduling a separate series of webinars for sustainability reporting. We'll schedule a separate number of webinars for our not-for-profit clients, but this is the core of our webinar offering. And it's already scheduled for the whole year. So please register. And then also, we've got a monthly accounting news, which I think we will have to rebrand to corporate reporting news very soon, because it's much more than just debits and credits. So please register for those. Please link with Kevin and I on LinkedIn, or with BDO Australia, with LinkedIn. We share information on a regular basis. This morning, I've shared another publication around the latest accounting standards and developments for 31 December 2021 reports. Also, we've got our IFRS and corporate reporting leaders across Australia. Please reach out. But we're no longer location-based. You can reach out to anybody. We find the most appropriate person with the knowledge to help you. And we've got a large team, and the team is growing. We've got 3 new people that started recently, so I don't even have photos for them yet. We need to get them to the office to take nice professional photos. But the team is growing. So, please reach out if you're looking for any assistance. I'll end up, it's 12 o'clock. Thank you for joining us. We'll speak to you again next month. I'm so excited. We've got Ash Barty playing in the semi-final at the Australian Open today. We've got the amazing Dylan Alcock, hopefully winning his last game as well and taking out another Grand Slam. And obviously the Special K. So there's a lot of tennis action for me to enjoy up to Sunday. I hope you have a lovely day, a lovely week. Kevin, enjoy your time in Orange, and we'll speak soon.
We're off to Dubbo today to go to the zoo up there, so looking forward to it. Goodbye, everybody. See you next time.
Bye.